This line that you see here, moving up and down, shows us one of the most important metrics for Bitcoin. It shows how many new people are joining the Bitcoin platform by creating new wallet addresses to store their coins. And just recently, it has plunged to its lowest level in 5 years. The last 2 times we saw such a sharp drop, Bitcoin fell by more than 70% in the following year. This naturally raises the question whether today's collapse in the number of new Bitcoin addresses is flashing another major warning sign. Is this the moment to sell Bitcoin and get defensive, or can Bitcoin's bull market continue despite this free fall in the number of new Bitcoin addresses? You see, every new address gives us insight into usage, speculation, and overall confidence in the asset. And when we put them all together, they create a real-time snapshot of Bitcoin's demand by directly looking at the network itself. Because at its core, Bitcoin isn't just an asset, it's a network. And like any other network, whether it's phone, the internet, or social media, its value grows exponentially as more people use it. Just look at the early days of the internet. In its first decade, it reached around 400 million users. But over the next 10 years, that number exploded to over 2 billion and led to the dot-com melt-up. Bitcoin, by comparison, has already onboarded over 600 million users between 2013 and 2024. So not only is it growing, it's growing faster than the internet did during its breakout phase. Normally, you would want to see adoption push Bitcoin's price up. That is certainly what we have seen throughout Bitcoin's history, where price was directly influenced by the number of people adopting the coin. In the last 2 bull runs, for example, so here in 2017 and here in 2021, the number of Bitcoin addresses rose aggressively as Bitcoin rallied. And right before the major decline in 2018 and again in 2022, addresses started to fall as Bitcoin entered a bear market. That's because when fewer people are using the Bitcoin network, it's historically been a warning that retail interest is fading. So naturally, with new Bitcoin addresses falling to 5-year lows today, many are concerned about a rollover in Bitcoin's price. However, something that we've been talking about extensively in our recent crypto videos is that something different has been going on with Bitcoin. Unlike previous bull markets that were driven largely by retail speculation and hype, this one appears to be fueled by institutional capital. We're seeing high conviction buying from entities that weren't even in the picture until recently. For example, Abu Dhabi's sovereign wealth fund has accumulated 4,678 Bitcoin over the last year, an amount that now makes up nearly 5% of their portfolio. And Wisconsin's state pension fund, traditionally known for conservative asset allocation, has added 3,442 Bitcoin, now totaling roughly 1% of their total assets. These are not retail traders. These are long-term, multi-billion-dollar institutions that are reallocating capital into Bitcoin as part of a strategic portfolio shift. What's key here is that large inflows like these don't necessarily show up as a rise in Bitcoin addresses because the coin is consolidating into fewer hands. In simple words, more Bitcoin is being bought by fewer but much larger players and being stored in a smaller number of addresses. And we do have evidence to support this. But before we get into that, make sure to take advantage of the 30% discount we're doing on our crypto trading membership. Our mission is to make profitable trades available to everyone. In the past month alone, we've locked in an average return of 185% across 34 winning trades. If you want to know what trades we're watching, why we're entering, and exactly how we're managing risk in real time, make sure to secure a membership. This discount is a rare opportunity and won't be around for long. One of the clearest signs that Bitcoin is being bought by fewer, larger players and stored in a smaller number of addresses is the timing of the divergence between Bitcoin and the number of new Bitcoin addresses. It began right here after the launch of US Spot Bitcoin ETF, which has been a major gateway for institutional adoption. Take BlackRock's iShares Bitcoin ETF, for example. It currently holds around 664,000 Bitcoin, which is roughly 3.17% of the total Bitcoin supply. But here's the key detail. Those coins are spread across only about 555 addresses, each holding up to 1,200 Bitcoin. That's a huge amount of Bitcoin being stored in a very small number of wallets. The Bitwise Bitcoin ETF has also disclosed its one and only Bitcoin address. It holds around 38,700 Bitcoin, or 0.18% of Bitcoin's supply. And this pattern is not limited to Bitcoin ETFs only. We're also seeing it with something called Bitcoin treasury companies. These are corporations that hold Bitcoin as part of their reserve strategy. Firms like MicroStrategy, Tesla, and Nexon have added Bitcoin to their balance sheets in place of cash. MicroStrategy alone holds 580,250 Bitcoin, which is about 2.76% of all coins that will ever exist. And 87.5% of MicroStrategy's holdings are stored in just 491 Bitcoin addresses. So what we're seeing today isn't just institutional adoption, but also a consolidation. More Bitcoin is flowing into the hands of a few large players who are holding these coins in a relatively small number of Bitcoin addresses. And if institutional inflows continue, which we happen to think should be the case, then this trend may only accelerate. So while the number of new Bitcoin addresses is falling, that doesn't necessarily mean the bull market is over. This time really is different because it's not being driven by retail hype, but by institutional capital with deeper pockets and longer time horizons. And as that capital continues to flow into Bitcoin, we could very well see Bitcoin's market cap grow as fewer addresses control a larger share of the supply. Now, in the near term, Bitcoin has broken below its steep uptrend line and has seen a correction of almost 10%. This is a scenario we highlighted in our recent crypto video, where Bitcoin was likely to see a healthy pullback after a powerful rally. We believe a move down toward the key moving averages around $95,000 could offer an attractive buying opportunity for the next leg up. That would be similar to what we saw in March 2023 and January 2024, both instances where Bitcoin reclaimed these key moving averages from below and then came back to retest them before moving higher. Of course, if price starts to slice below these moving averages, we would become more cautious in the near term. But for now, that's not our base case.